Hey guys, what's up? I'm Erin and welcome back to the channel. We are almost 8 months into a tumbling stock market and in a freshly minted recession. So what happens next? Well, quite frankly, we are all gonna find out together as we live through it in real time. But we might be able to gain some insights into what might happen in the next couple months or even the next couple years if we look back to see how the market has performed with past recessions and past bear markets. So the recession is official. Something we all knew was going to be announced was finally announced. Big surprise, I know, right? What about the market? Is it a bear market? Well, maybe. Briefly earlier in the year, the S&P did dip into bear market territory. It went down by 20%. But as of right now, as of the filming of this video, it's not in bear market territory. So what do we call this market? Was it a bear? Is it a bear? Is the bear coming back? Honestly, it doesn't even matter. The market is down, inflation is high, and we can all feel the economic tensions. So whatever you want to call it, it doesn't really matter because we can all feel that it's real. Simply acknowledging the situation is probably more important than getting hung up on some technicality. Since 1950, there have been 10 previous periods where the S&P 500 has declined by 20% or more. Just to drive home that point, that time span covers 73 years. So they're not really all that common. And while these bigger drops, these 20% or more drops might not be that common, smaller drops are fairly commonplace. For instance, a 5% or more market decline happens on average 3 times per year and typically lasts about 46 days. A 10% or more decline happens on average every 1.8 years and lasts about 117 days. A decline of 10% or more, but less than 20, is officially called a market correction. Once you hit that 20% threshold, it becomes a bear market rather than simply a correction. There have been 39 market corrections since 1950, so that means you're bound to see a lot of market corrections throughout your investing career. A decline of 15% or more happens roughly every 3.5 years and lasts 275 days. Quite simply, the bigger the drop, the longer it generally takes to recover from. And those 20% or more declines, those bear markets, when we average them out, they happen once every 6.3 years. They take a bit longer to recover from too. On average, 425 days. Those steeper declines, those declines of 20% or more, tend to take longer to recover from because there's generally more factors at play. For instance, most bear markets have traditionally coincided with recessions. And these recessions tend to come about because of greater economic imbalances. And these imbalances, combined with a slowing economy, generally tend to lead to a slower market recovery. When these more severe market downturns happen, how long do they last? Well, historically, they have lasted an average of 14 months, with an average market decline of 33%. Now, of course, the market doesn't give a flying flip about averages. How long any market downturn will last, how severe or how mild it may be, really depends on these individual circumstances. But these averages can give us an indicator of what is typical. But if this market downturn wants to go ahead and be average, well, guess what? We are 8 months in, so perhaps that means we only have another 6 months to go. Perhaps that's a glass half full kind of way to look at it. However, worth noting, the longest bear market in history took 30 months to recover from. That's 2.5 years. The shortest bear market in history, 2 months to recover from. And I don't know about you, but I personally don't want to try and set a new record on the long end of the spectrum, so hopefully we fall somewhere in the middle. But as far as how other bear markets have fared, we aren't anywhere near as severe of a drop in this one. As I said before, the S&P 500 did briefly dip into bear market territory before rebounding. The typical bear market is down an average of 33%. So if averages have anything to say about it, maybe we have further to fall. But we're in kind of somewhat of a unique situation, as demand from consumers is still very high. It is helping to bolster company sales, which is keeping unemployment levels very low. So in this sense, this recession is kind of rare. It doesn't have all the traditional markings of a recession. The steepest market decline of the past 73 years goes to the 2008 financial crisis, where the markets fell by 57%. So when those headlines from all the news outlets are coming at you fast and hard, saying how bad things are, just remember, it's been worse before. And always, this is not a positive way to look at things, but things could always be worse. So maybe have a little more appreciation for how things are today. But let's throw that graphic back up one more time, because while it shows that the average bear market lasts 14 months and hits us with a 33% loss, the other side of the spectrum, and perhaps more importantly, it shows that the typical bull market run goes for 71 months. That's almost 6 years, and returns almost 263%. Yes, as stated before, those are averages, and no bear market or bull market is going to be exactly alike. But there is a common theme. Those bull markets are longer and more robust, and that is why it pays to be an investor. Intellectually, we all know that when the market takes a hit, that is the prime buying opportunity. That's when stocks are on sale. You can buy pieces of these wonderful companies at great prices. You can get stocks at better prices than we've seen in years. But that's not what we see happen. Instead, most people sell when the market is down, fearing that they have lost too much and don't want to lose any more. And when the markets are soaring, that's when people are funneling more money into the markets than ever before. It happens time and time again. This trend consistently happens in every bear market and every bull market. This chart shows investor behavior during the 2008 financial crisis and its recovery. The money started funneling in only after markets had recovered, and this was repeated in just the past couple years. Yes, of course, money has a psychological component to it, but you absolutely do not want to be selling at the bottom of the market, sitting on the sidelines waiting for it to recover, only then to be buying in at new highs. That is the opposite of every piece of financial and investing advice that anyone has ever been given. You always hear buy low and sell high. In this case, most investors are buying high and selling low. Don't do that. The best thing you can do as an investor is to stay invested, and perhaps bolstering your cash reserves can help you stay invested during these turbulent times, as I recently went over in this video. But on to that more important question. Once this downturn hits and you've stayed invested, what can we expect to happen next in the markets? When we look at 15% market downturns, within 12 months of the bottom, the market has averaged a return of 55%. That's why you should wait it out. The most robust portion of a recovery tends to happen fairly quickly in these downturns once they find bottom. That is why it is so important to just stay calm and stay invested. But what about the bear markets or these more severe market downturns? As I said before, they tend to linger a bit longer. Their recovery is a bit of a longer road. Well, surprisingly, it's not all bad news. 6 months out from the bottom of a bear market, 60% of bear markets already have a net positive return. 3 years out, 89% of these bear markets have seen net positive returns with an average return of 29%. So that means all you have to do is wait. Because that time is going to pass anyway. 6 months, a year, 2 years, 3 years. Realistically, it's not that long of a time frame, especially when you compare it to your entire career as an investor, which will look something more like 30 years, 40 years, or even 50 years. And honestly, recent market downturns have tended to find quicker recoveries, meaning recessions and corrections are getting shorter. On average, not true in every single situation, but true enough to make a sweeping generalization that is bound to make 1 or 2 people mad, so why not say it? Prior to 1986, most market corrections took over a year to find bottom. But since 1987, there have only been 3 market corrections that have exceeded 104 days. That's just 3 months. And I was born in 1987, so perhaps I'm some sort of a good luck charm for the market. Actually, that's not true at all. I was born in the middle of a very severe downturn, so probably zero truth to that. But while these market downturns do hurt, it helps to know that they are becoming briefer in nature, on average. So when in doubt, just ride it out. The NASDAQ, the Dow, the S&P 500, these indices will rally. Eventually, these downturns will be in the rearview mirror. In rolling 20-year periods, there has never been a time when the market has had a negative return. The market favors the investor who is in it for the long haul, the investor who is patient and just rides it out. We can expect the market to turn around. Most bear markets are net positive just 6 months out from the bottom. Nearly all are positive 3 months out. So I guess the next question becomes, when will we hit bottom? Actually, I did read an article from JP Morgan Chase this morning saying that the bottom is near. But keep in mind that no matter what anyone says, no matter what any corporation or government says, no one really knows when that bottom's going to happen. But we do know that we should stay invested. Let me know your thoughts down below. When do you think the bottom might hit? Do you have any predictions that you want to throw out there? I'd love to hear what you have to say. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I appreciate you, and I will see you soon. Have a good day. Bye. But if this, a kind of look at it. Hey guys, whew, we can expect the market to turn around. I feel like this, like a little too much, like flapping of the wings. No, not coming off market. And no. 8 months into, no, did 104 days. What's gonna happen next? With previous recession. Now we are 8 months, okay. Might be able to get these recessions I'm gonna sneeze. Holds before us. I didn't like that. Deserves a golf clap. And now, of course, the are getting shorter. I am sweating, like it is so hot. So the recession, whatever you really want to call it, it really just feels like a lot. It doesn't really matter. That is buying high and selling low. You don't want to do that. The best, I don't know what I said. Buying low and selling high. I don't know what I said. Yes, of course, another 6 months. It wants to go ahead. Kind of look at it. Oh, it's been worse. The steepest past 73 rebound tends to happen, lingers around. What does that look like? I don't like that at all. The market finds its bottom. Many times I have said average in this video, but I feel like it's a lot. JP Morgan Chase says they know. They don't know.